Like virtually everyone else in America, policymakers generally have romantic ideas about home ownership. People take it for granted that home ownership is desirable, and we rarely get past these sort of vague ideas about the power of the American dream. But if we're going to make promoting and even subsidizing home ownership a public priority, we need to spend a little bit of time thinking harder about why. Is affordable home ownership about providing shelter? Is it about offering kids a safer place to grow up? Or is it an economic development strategy? Is it about reducing traffic by allowing the workforce to live closer to their jobs? But if affordable housing is about any or all of these things, then we have to recognize that affordable rental housing does a fabulous job of meeting these goals. And when we consider subsidizing home ownership, we have to start by acknowledging that it generally costs more than rental housing for each unit that we create. So if we're going to invest scarce housing resources into the creation of home ownership units, then those units have to offer something that's more than what we get when we build affordable rental housing. Adding to that challenge is the fact that the same affordable home ownership units that cost a little bit more initially can cost vastly more than rental housing over the long term. These days we tend to keep rental units affordable and available for low-income families indefinitely. But unless we take some special steps, an affordable home ownership unit is only going to serve one family. In response, local governments have developed a set of tools to preserve the affordability of affordable home ownership units so that they can serve one family after another, just like affordable rental housing. They do this by asking for something back from the homeowners when they sell. Affordable home ownership programs generally fall along a continuum, with some offering homeowners unlimited asset building but failing to protect affordability, while others preserve affordability by limiting the homeowner's wealth creation. Homeownership has a lot of benefits. Homeowners have stable housing costs, they tend to stay put longer than renters, homeowners have more control over their housing, they seem to be more committed to their neighborhoods, and on and on and on. But it's hard to explain the interest in promoting homeownership without mentioning wealth creation. For some people, if the goal of local housing programs is to help people into home ownership, that's because ownership is the key to wealth creation in America. If you give people home ownership, you give them a step up, a path for economic advancement. And that path is something quite different from what we get in rental housing. There's a growing academic literature about the importance of wealth, independent from income. It turns out that two families with the same income have different outcomes depending on the level of family wealth. The kids from the less wealthy family are less likely to attend college, more likely to have health problems. Differences in wealth have a more lasting impact than differences in income or education. Differences in wealth are passed down from one generation to the next. And it turns out that in America, home ownership is the primary vehicle for wealth accumulation for most families. But it didn't have to be this way. American society has placed a high priority on home ownership. A series of tremendously successful federal programs launched in the 30s and 40s sought to make home ownership accessible to a greater range of families and virtually transformed a generation of working-class families into the stable middle class that we know today. Working-class men came home from the war and bought houses like these by the millions thanks in large part to federal mortgage insurance programs. And decades later, their homes had increased in value and they used that equity to send their kids to college and to help them buy houses of their own. The children of homeowners are more likely to buy houses themselves, they buy them at a younger age, and they buy better houses in better neighborhoods. The grandchildren of these homebuyers are more likely to attend good schools. But this fantastic asset building opportunity was not available to everyone. The federal government itself promoted the idea that mixed-race neighborhoods were undesirable and encouraged mortgage lenders to deny credit to certain borrowers in certain neighborhoods. The result was that home ownership was unattainable for many non-white families. And it's not that the federal government had no program for everyone else. It's just that these other housing programs didn't leave people with something to pass down to future generations in the way that home ownership did. The grandchildren of the public housing residents face a very different set of opportunities than the grandchildren of those homebuyers. The legacy of these policies can be seen clearly in the assets of American families. While over the past 50 years we've made progress in closing racial income gaps, wealth gaps have not improved. In fact, they've gotten worse. The average white family owns 10 times the assets of the typical African American family. And again, most of that difference is the value of their homes. So it makes sense that we have an interest in promoting home ownership, even if it's more expensive than rental housing. But home ownership is broken. It's no longer functioning the way it has in the past as an asset building tool for working families. You'll often see this problem stated in terms of what income a family would need to purchase a median-priced home, but I suspect that statistic doesn't quite do justice to the problem. I want to look at it in a different way. This is a chart of the incomes in Monterey County, California. The income chart is basically a chart of the workforce. This is what the local jobs pay. Now here's the same chart, but instead of incomes, at the bottom I'm showing how much each group could afford to pay for housing. These are rough estimates. Everyone's circumstances are going to be different, but I'm sure that you can see that while some people can afford $500,000 or more, most of the people can only afford $100,000 to $300,000 homes. And it really wasn't that long ago when the housing market offered options at each of these price points. But that's not how the housing market works anymore, is it? To get a rough sense, let's look at Zillow.com. Zillow is a website that predicts the value of homes based on comparable sales. They have this feature which maps property values, and I'm sure it's inaccurate in a lot of ways, but I think it gives a pretty good high-level sense of the problem. The yellow dots represent the few places where you might find starter homes in the high 600,000s. But the orange dots represent all the areas where small starter homes would cost more than $900,000. Just so you can see how few people we're talking about, I colored the income chart to roughly correspond with the map. The potential buyers here are only at the extreme tip of the income curve. The people in red and some of the orange. Everyone else is totally out of luck. Of course, some of those people already own homes, but if they were buying today, they'd face real problems. Now, the Monterey Peninsula is one of the most expensive housing markets in the country, so it shouldn't be surprising that very few people can afford to buy there. But let's go inland and look at Salinas, which is a much more typical market for California. Here we see some yellow, and if you look closely, a few pockets of light green. But look at the income chart and think about how, still in Salinas, home ownership is only for a small part of the population, at the top end of the income curve. All the other people live at the other end of the curve, the blue end. If asset building has generational consequences, and home ownership is central to asset building, you can see here the extent of future social problems in the making. Here's LA. And Oakland. And this is San Francisco, where it's hard to even find any yellow dots. If the point of promoting home ownership is that it offers people a way to get ahead, then obviously we can't do that if the only people who can get into home ownership are people who are already ahead. So I want to ask you to think about what the world would be like if we still actually had $200,000 and $300,000 homes in these places. And where you live, it might be $150,000 we're talking about, but homes that ordinary people could actually afford. If there were $300,000 houses available, a family in the middle of this income curve could buy one with about $15,000 down, and 10 years later they could sell for around $540,000. The family would take over $250,000 with them. That's their appreciation, plus what they were able to pay down on the mortgage, less the cost of selling the house. This assumes that house prices rise at about 6% annually. Pretty close to the 50-year historical average, but far below the average in most of the country over the last 10 years. But because they're earning 6% on the full price of the house, not just on their down payment, the return on their investment is far greater. To turn $15,000 into $250,000 in 10 years, you'd have to earn 33% annual interest. In other words, home ownership can be a really great investment. It has been a really great investment for many families. There's simply no other safe way to earn this kind of return on your money. There are a lot of other great things about home ownership, and some really bad things, but it's hard to explain the excitement without this one fact. But what happens when all those blue families can't find housing that they can afford? Some of the blue families will manage to buy the green houses. Those families will either be stretching their budgets to the max or using loan products that are like ticking time bombs, or both. For all that's great about home ownership, when people are gambling with their futures with interest-only adjustable rate mortgages, it's a sign that home ownership has been oversold. There's an important difference between affordable and attainable. A growing body of research is showing that lower-income families aren't realizing the asset-building benefits of home ownership. Lower-income families generally have less stable income and less cash savings. A temporary loss of income or a large unexpected expense, like a medical expense, can force a family into foreclosure. When low-income buyers spend more of their income to get in the first place, when they borrow at generally higher interest rates, and when they use adjustable rate loans, or worse, interest-only adjustable rate loans, there's a much greater chance that they'll face a problem later which will wipe out all the equity they've accumulated in their home. And on top of that, to get into home ownership at all, many low-income home buyers buy homes that are either in less desirable locations or less well-maintained. Another strategy is simply to drive further from where the jobs are. All of these approaches reduce the asset building potential of homeownership, and a series of studies suggest that low-income homeowners are likely to experience significantly less price appreciation as a result. For all its benefits, homeownership is probably oversold as a strategy for low-income families. Policymakers should be careful not to simply assume that homeownership will automatically result in asset building for lower-income buyers. We can design programs that greatly improve the odds, though. And the first step in that process is ensuring that low-income buyers have homes that they can actually afford. Instead of relying on financing tricks to stretch buyers into homes that they can't actually afford, we have to create homes that sell at prices which the wide spectrum of people can actually afford on their own. One way that local governments do that is by either inducing a developer to create a small number of $300,000 units along with their more expensive houses, or by providing a subsidy to make $500,000 homes available for $300,000. Ideally, we create different opportunities at different price points. Now, in this light, let's come back to the question of what's the appropriate split of equity at resale. There are a lot of options. One thing we clearly should not do is let them sell the home and keep all the subsidy. If a $300,000 home rises to $540,000, then a $500,000 house will rise to $900,000. In that case, the family walks away with nearly $600,000 instead of $250,000. If $250,000 was a fantastic leg up, $600,000 is winning the lottery. Another option is to simply recapture the initial subsidy. If they pay back the $200,000 subsidy, the community can reinvest that money to help another family. But if housing costs have risen, it will cost far more than $200,000 to help the next family. And this first family will still receive far more than they would have if there had been $300,000 houses available in the first place. To me, the most generous option that makes any sense at all is what we call shared appreciation. San Francisco, for example, calculates the discount that you received as a share of the market value and then recaptures that share of any appreciation. When someone buys a $500,000 house for $300,000, they're getting a 40% discount. If the house is worth $900,000 when they go to sell, they owe back the $200,000 plus 40% of any appreciation. This would leave the homeowners with $253,000 in equity at the end of the day. If that number looks familiar, it's because this is exactly what they would have earned if there had been $300,000 houses available for them to purchase in the first place. And notice that even if there were $300,000 homes, this family might prefer this shared equity home. Instead of living in a $300,000 house and earning appreciation on $300,000, they live in a $500,000 house, in a $500,000 neighborhood with $500,000 schools, and they earn appreciation on $300,000. The problem with shared appreciation is this. Recapturing a share of appreciation from the first family would give the program $360,000 to help another family. But if the market value of our $500,000 house is now $900,000 and incomes have not quite kept up with home prices, then we would have to come up with an additional $95,000 in new subsidy funds just to maintain the same level of affordability. The alternative is what we call subsidy retention. We simply keep the subsidy in the house and make sure that the house resells at an affordable price. If we're trying to address the problem in the market where we don't have houses at a given price level, then there's a good reason to try to maintain that solution for more than one generation of homebuyer. We create a set of houses that will always stay blue. They won't move up the spectrum every time the market rises. But that comes at a cost. In this example, that means that the homeowner only receives $188,000 in equity, a mere 29% return on their investment. This is less great, but still pretty powerful asset building. So I think the question for policymakers is not, should homeowners be allowed to build wealth? The question is, how much wealth is enough? Is $188,000 enough, or does it take $250,000 to really change people's lives? How much wealth creation is necessary to make homeownership worth more than rental housing? While it's tempting to think that we have to choose between wealth creation and preserving affordability, we really don't. There's not much point in creating affordable ownership housing if we can't achieve both of these goals. The surprising reality is that many homeownership programs do just that. They attempt to balance these two goals by one way or another limiting the extent of homeowner wealth creation. But even the most restrictive programs generally offer homeowners tremendous wealth creation opportunities that are far and away superior to any other investment available to low or even middle income Americans. In spite of all the controversy, shared equity homeownership programs generally offer homebuyers their only avenue to the kind of wealth creation that homeownership has historically provided. They give up the potential to earn outrageous windfalls that some people earned during the housing boom, but they also give up much of the risk that lower-income homeowners face in the housing market. And the important point here is that by limiting an owner's wealth creation in this way, we're able to offer the same wealth creation opportunity to one family after another.